Silakan.
Oke.
Oke, silakan. Eko.
Ya, alhamdulillah, alhamdulillah, ala fa baila kurubina, ba'asbana bi ni'mati ihwana, asadu alla ilaha illallah wahdahu la syarikalah wa asadu anna Muhammadan nabiyya wa rasulullah. Alhamdulillah, praise to Allah, that we have an opportunity to have a wonderful guest. I think Brother Owaiz, I think I remember meeting you back in 2017 in Denver, where
Yeah.
we chat about our investment at that time. It was actually great year at that time.
Yeah.
Um, so Alhamdulillah, Brother Owaiz, tonight, inshallah, this is gonna be a kickoff of a series about financial literacy. So what I notice, it's like sometimes, yeah, at least I guess in the IMSA, we're learning about our dean, we're learning about other skill set, but sometimes managing our money in today's world, sometimes those skill sets is I would say it's nobody taught us, right? Um, Used to be back in the days, Brother Wise, you used to be
Mhm.
just balancing the checkbooks, right? I mean, those are
Right.
the
Right.
one of the one of the skill. But now maybe we kind of graduated from balancing the checkbooks now, since we're not writing a check anymore. Um, so that's, I mean, this is, I think IMSA and Alhamdulillah, have been, this is a good initiative by IMSA so that, our member, our listener of Radio IMSA, at least would have an opportunity to learn, how to manage money in today's world, especially for us who live in the West, especially for us who live in the US. Um, the second of all, we know what happened. I think when POTUS enacted a tariff early April, and then when you guys follow the stock market reacted negatively. There's a lot of uncertainties, and there is a lot of commotion, I guess, chaos on the market.
Mhm.
So, Brother Always, I think it's probably like, you can consider, IMSA members or listener into three categories, if you will.
Yeah.
One will be like the young adults, people who are new to this and then learn, and basically this starting working, and where are you gonna put the money? Like should I put, Roth, IRA or 401k or where? I mean, they don't have a lot money to invest, but
Mhm.
they need to invest, right? The second was basically mid-career, professionals. Maybe they have something saved up, or maybe they haven't. Maybe they haven't started, but they have some careers. They have some, basically in the working world. I mean, they have maybe 10 years, 15 years. What they should, what they should do, in regards to this, current market. And lastly, is for us if we want to go to retirement, what should we do? I mean, are we basically like, are we out of luck
Mhm.
with whatever that we have, right? So it's just basically like, just white flag and then call it done or call it quit, right? So I guess in that kind of premise, Brother Wise, maybe you can share your knowledge, mashallah. You've been professional in this space for 25 years. Maybe you can give us some kind of educational and then some explanation in related to the current market, and then so inshallah we'll do this for up to 40 minutes, and then we'll have a Q&A. I really for you guys to be a lot more engaging, and then please, basically like if you have question, just write down the question, and then at the in a Q&A session, we'll ask brother always those questions, inshallah. So, Brother Weiss, podium is yours.
Okay. Let me just question, did you want to record it then?
The question, whether to, yeah, probably so.
Or are you already streaming
No,
something?
no, I think it's
It's already being streamed
recorded.
to Facebook
Okay,
and
great.
YouTube, so we can get the recording
That's
from there.
perfect. That's perfect. Okay. All right. Well, I'm glad to take it away from here. and I'm happy to speak with everyone. This is something that I love talking about, and I've loved it for a very long time. My desire is to talk to as many Muslims as I possibly can, and whether they buy something from us or not, if people can take something away from these presentations, I would be happy, because what we want to see is we want to see Muslims flourish, right? And we need to see Muslims that are successful. The more successful we are, and the more dollars that we can contribute to our own communities, to our own organizations, the better we're going to end up doing. And I think what we've seen over the last couple of years during a lot of turbulence all around the world, and you all know what I'm talking about, is that you can't always trust companies what they're going to do with the money that you give them, or the profits that they make from what we give them. And some of them basically stab us in the back, right? And we don't feel good about that. So I'm glad that I left a company after working there for 19 years. I left in 2008, and I had a great time. It was a large financial services company, but I've never felt as good in my career than I do now, because I work for a company that gives back to our own Muslim community and does things in the right way. So we're going to talk about not only investing according to Islamic principles, that'll be a part of the presentation, but it's going to be about, how do we ride out turbulent times as well? What is the strategy? What do smart people do? Or not, let's not call it smart people, because everyone in the room is smart. You may not be doing this, but you're still smart. What do people do that have had success saving for their future, right? That's what we're going to talk about. So what we want to do here is we want to talk about a few different reasons you want to save. So if someone is not saving right now, they're not investing, they're actually losing value, right? So if you had $100,000, you're not earning interest on it, because we're Muslims, we don't want to get the riba. The interest comes out of the account, we don't even see it. So the $100,000, before, when I used to talk about inflation a few years ago, people would have a hard time understanding what inflation was. And now people know exactly what inflation is, because we've all seen it after COVID, that the same eggs that you want to buy, or the same milk, or anything, right? Anything for your kids, a house, cars, everything has gone up in value. So if you had $5,000 for the next year's cost, it's actually now going to cost you $6,000, and the next year is going to cost you $7,000. So you can't just let it sit. You have to let it grow. The money that you have for the long term should not be sitting around losing value. It's going to lose economic value. So one of the reasons people save and invest is to have a down payment for a house, or to go to Hajj, right? If we were having an interactive session, I would ask you, how much does Hajj cost in your area to sign up for it? And a lot of times people will say it costs 15,000, 13,000, something like that. So you can't just luck into it anymore. You have to actually plan for it, save for it. If you're married, there's two of you, it's going to cost you $30,000. In the old days, we could just say, should we go to Hajj next year? And we'd say, yeah, let's do it, right? And make all your plans, get everything ready. You have enough money. It's not that much. And so people were able to go. And another cost that's quite large, that's why we talk about this, is children's education. But it's not just education for children, it's setting them up in life. Because what we're seeing is home prices are going up so dramatically, and incomes are not rising as fast, that if you and I own a home, will our children be able to own a home, right? So being the good Muslims that we are, and the good family members that we are, we may want to save a little bit for them, to give them that down payment, right? Make it a little bit easier for them. We're not going to take care of all their cost in their life, but we can try to do what we can. So there's ways to do that. And then obviously retirement, as you're seeing, there's a lot of attacks on Social Security, Medicare, Medicaid, and government benefits that we've been paying into for a long time. I've been paying into Social Security since I was 19 years old. If I could have put that into investments, I would have way more than I would get from Social Security. But Social Security is me putting in my money, and it's paying for somebody else's retirement right now. Hopefully it's still there. And the problem is it's not enough typically, right? So we need to plan for that, brothers and sisters. We cannot be negligent on planning for retirement. If you are, you're going to find that it's going to become very difficult. Because even if you own a home, you still have to pay property taxes. you still have to pay the ever rising cost of homeowners insurance and everything else that's going on in your life. And then the final one is health savings, which we're actually not going to talk too much about. So I'll just mention it here. If you're in a high deductible health insurance plan, HSA qualified, you can put up over, if you're a family, you can put more than $8,000 per year into it if you want to. You can put less if you want, but it's a triple tax advantage. So every dollar that you put in will be tax deductible. It grows tax deferred. And then when you pull it out for medical, vision, or dental, there's no tax on any part of the withdrawal, the gain, or anything else. So it's a quite a large benefit that people get from that. Some of what I'll talk to you about today will involve numbers and assumptions. And if I tell you I'm assuming a 7% rate of return for the next 40 years or for the next 18 years, that's not a guarantee of return. It's just an assumption that we need to use. We need to use some number. And then you can ask me why I pick 7%. That's not a problem. In fact, start writing down your questions or put them in the chat group along the way. Try not to remember them. Just put them down so you can ask the questions down the road. Now, if you want to be a successful investor, and you might think, I'm not an investor. Well, if you have a 401k or an education account for your child, you're an investor, because you're typically not going to keep that in a savings account within a 401k. Almost nobody does that. So you are an investor. So if you're an investor, you want to invest for the long term. If you have short-term money for 2 or 3 years, that doesn't need to go into an investment, right? But the money that you have for the long term, 3, 4, 5 years, you want to keep it in there for a long enough period of time to get the value from the market and overcome any obstacles or down periods, right? Times when the market has gone down. And then you're going to see, I'm going to demonstrate to you why it's so important to save early and often. You're going to save every month if you can, right? If you can't do that every quarter, but it has to be something regular. People that have a 401k, it's automatic. It comes out of their payroll every 2 weeks. If you ask people in this chat group here or in this Zoom group, where's the biggest pot of money? They're going to say it's the 401k. It's because it's automatic. It's every 2 weeks. It's happening whether they remember it or not. And then you want to diversify. If you're buying stocks on your own, it's very difficult to diversify. That's why there are different kinds of mutual funds there for you, right? So any mutual fund company will typically not just have one fund, because you're not going to be able to diversify enough by just having that one. You don't want to time the market. I talked about that before we even started the session. And if you try to time it, you have to make 2 perfect decisions: the decision when to buy and decision when to sell, and then when to get in again, right? And you can make these mistakes over and over again, and that's when people lose money. I'll just give you a couple more. Understand volatility. So if you're going to invest, know that there's going to be downturns. Since 1928, the S&P 500 has been up at the end of the year 72.2% of the time. That means it's been down 28%. So 1 out of every 4 years, it's down. But during that time from 1928 till now, the average market return has been 9.6% per year, which is a phenomenal rate of return. And you'll see that when I give you some calculations in a little bit. So I'll leave it there on that part of it. Some folks, they wonder, what should I do first? Should I pay off my debt? Should I start investing? I mean, I think you can do both at the same time, but the first thing that you want to do is have an emergency fund in case of a downturn in the economic cycle, the business cycle. So for example, if there's a huge unemployment number, right? So right now it's like 4%, 4.5% of the people that want to work don't have jobs, but there's been times where it's been 15%. It's a long time ago, but it has happened. So if you get caught up in it, what are you going to do, right? If you have 6 months of unemployment, what are you going to do? And, we saw that federal employees that had some of the most secure jobs in America, thousands of them just lost their jobs. So hopefully they had enough saved up. So you want to have at least 3 to 6 months worth of savings in your account that says, if I lose my job, how much do I need on a monthly basis for the next 6 months or the next 3 months? And so that way I won't lose my house, I won't lose my car, I'll still have food on the table, etc. And then pay off your credit card debt, because we know, first of all, credit card debt and interest is riba and is not okay. But some people unfortunately have gotten into that before they understood it. So try to pay that off first, not only because it's riba, but also because it's the highest interest rate. And oftentimes people are making payments to it, and it'll take them 20 years to pay it off. So that's another thing that you want to keep in mind. And then if you have other low interest debt, like a car debt or a personal loan or a credit line or something, and it's riba, you want to pay that off too. You want to get out of that and start making your money be halal, right? Earn your money in a halal way, spend your money in a halal way, borrow your money in a halal way, and invest your money in a halal way. Take advantage of the 401k match at your company before you do any other type of investing. If, for example, if your company offers a 4% match, meaning that if you put in 4% of your salary each year, so if you're making 100,000, you're putting in $4,000 a year, they will match $4,000. That's a double on your money right away. So you don't want to wait on that. You want to take advantage of that. And then the next one that I'll go to is putting in money into HSA and Roth accounts, right? So if you have a Roth account, you're going to be able to pull out the money without penalty or taxes after, or the money that you put in, you're able to pull it out without tax and penalty. It's an amazing way to save money. And the HSA gives you that triple tax advantage. The next part, if you've done all these things, then you can think about maxing out your 401k. You paid off your debt, you have money in your 401k, you have money in your IRA, your HSA, in your Roth IRA. So now you can say, I need to put in more money. I want to max out my 401k, and I'll show you what the max out numbers are. You could prepay some future expenses. You could have, your property tax could be $5,000 a year. So you're starting to put some of that away every month. So you're prepaying your future expenses. And then hyper accumulation means that you're now beyond the part of your life where you're paying for your children's education and everything for your kids. You have the highest income you've ever had. You have the lowest debt or no debt that you've ever had. So now you can really start to put your money to work for you in every type of different type of account to invest your money. And it's pretty easy to save. If you start saving when you're just born, you start saving for your child. For every $1, by the time the child is 65 years of age, it'll be worth $647, right? That's incredible. But if you miss that opportunity when they're 10, it'll turn into 239. This is the power of compounding. The more time you have, the more doubling and tripling the money can do. But $1 didn't just become 10 times the amount. It didn't go from 1 to 10. It went from 1 to 647. So this just kind of demonstrates what compounding does. I'm going to start off with investing for college. Not all of you have children that are going to college, but this will give you a good example of how to save for anything, not just for college, right? And if you have grandchildren, you could help them. If you have nieces and nephews, when a birthday comes up, you can write them a check and say, I want you to put this into the college fund. This is why instead of giving you a $50 gift, I'm giving you a $100 check. But the contingency is that, or the caveat is that you're going to put this into an account for your college education, because we know in our community, everyone's going to go to college, right? So the cost of college actually declined recently for the first time ever. It used to go up about 7 to 9% per year. But even with that reduction in public college cost, or the inflation rate of it, it's still a very expensive thing to do, right? So tuition rates can average from 11,000 to 41,000 per year. Imagine your child is now 18, they're going to college, you haven't saved a dime, and they say it's going to cost me 5,000 for the first semester or 20,000 for the first semester. What are you going to do? You're going to start taking out debt, right? You're going to have to take out student loans and have that be around with them for the rest of their life. We don't want to do that. So we want to be able to save for them in a better way. So this is just showing you the average cost of college over time. It does increase. You can see at the top part there, it's tailed off a little bit. I actually think it's going to go back up again. Part of the reason is that there's been some things that have been happening on the federal level that could make that happen. So the average student, when they came out of college in 2019, came out with almost $30,000 worth of debt. This is including people like you, some of you and me, who came out with zero debt because maybe our parents helped us, maybe we were working part-time and our company was paying for part of it, and the cost was just lower. But some people have zero debt like us, and some people have $200,000 debt, and a lot of people have 40 to 60,000. And so the average is $30,000 before they even start their financial life. So how can we eliminate that? There's different types of plans. We are working with a 529 plan company that hopefully will start to add the amount of funds. This has been a project we've been working on for years. So it might come to fruition later this year. We're really hoping that that happens. Right now, there are no 529 plans that can do this. But if once we get the 529 plan, you're going to have a huge amount of money you can put aside and not get taxed on that money. But for now, you can open up something called the education savings account. By the way, if you're wanting to, on your phone, you're looking something up, you can find all these things on our website, amanafunds.com, AMANA funds.com. So you can see, you can go to the education savings account brochure, the IRA brochure, etc. But in the education savings account, you can put up to $2,000 per year. It's not a lot of money, but if you're putting in zero, it's better than that, right? And you can put it into the income fund or the growth fund, which I'll talk about later, and you can start to build upon the $100 you start with and the $2,000 you put in per year. But if you don't have 2,000, you can put in less. If you want to put in more than 2,000, or you don't qualify for an education savings account because your joint income is over $190,000 per year, you can open up a minor account, what's known as a uniform gift to minor. And you can put in $18,000 per child on this particular one per person. So if you have just the father, that's 18,000 per year. If it's father and mother, it's 36,000 per year. So now this is the exciting part. How do we actually build enough money for your child's education? So your child is born, you're waiting for their social security number, you already know their birth date, you go in and you open up an investment account and you start it up with $100 and you put in $83 a month because that's $1,000 a year. So, and you just happen to be getting a 7% average rate of return, right? So this is like, it's growing at 7% per year. What that means is you could have a year where you're down 2%. You could have a year where you're up 30%, and anything in between. What I'm saying is the average of all those years is 7%. So you put in $1,000 when the child was born up to 3 years old. So for 3 years, you put in $1,000 a year. So you put in $3,000. And with the 7% rate of return, you have almost $3,200 in that account. Not very exciting, right? 3,000 became 3,200. But again, this is where the power of compounding comes in. If you go all the way until the child is 18, you will have put in $18,000, but you've almost doubled your money. And if you recall, how much did we say that the average student came out of college in debt? It was 29,900. So in this case, if you had 34,000, you would have been able to take care of that particular child's debt. They wouldn't have had debt because you would have been paying out of this education account. But I had said the maximum per year is 2,000, which means that this could become $70,000, right? If you would have put in $166 a month. What you could do is you could go to different organizations like ISNA.net or Islamic Scholarship Fund and try to get a scholarship for your children. And the benefit of that is that you're only going against Muslim children, okay? Because those are the only ones that are going to go to these websites to look for these scholarships. So you're not going up against 100% of the students. You're going up against 1% of the students to get a scholarship. And then the last bullet point there is a continuouscharity.org, which is the same one as acceducate.org, same one. And that one allows you to take a loan out, a student loan without interest. So it's going to be, you're going to pay it back when you get out and you go to, you start working. And at that point, you'll start making monthly payments. But until then, you don't have to make payments, and the payments are not going to include interest as well. All right, so that's education. You can actually just take it off your plate by just getting an education savings account started, or start up a minor account, or both, and you'll benefit yourself in the future. You're not going to have that $83 per month to spend on your own, but that delayed gratification is going to pay for college. So that's the way you want to think about this. Now, when we're talking about retirement, if you're younger and you're in this audience, I want you to pay particular attention to this. Usually the people that are older, closer to retirement, they're going to really pay attention, but the real benefit is going to be for people that are even younger, right? Because I just demonstrated to you how the power of compounding works. And so you want to make this work in your favor. My daughter started working part-time at 18, and she started a Roth IRA because she's seen this presentation a number of times. So in your retirement, you're going to have different forms of income. One is from whatever you've saved up. The second is a pension plan. The third is Social Security, and the fourth is employment during retirement. Now, the first one, you have all control over that. The second one is a pension plan. Most people do not have a pension anymore. That's usually federal employees, state, city. They usually get those kinds of things, firemen, policemen, elected officials, things like that. But the vast majority of us don't have that. So you can actually cross that off your list. The next one is Social Security. Is it going to be enough? And the last one is employment during retirement. But is that really retirement? For some people, it is, because they stopped their 50-hour per week job, and now they're working 20 hours per week to keep their medical insurance going and, still be doing something, right? Because they don't want to completely retire. But that's not really going to get you all the money that you need. So a lot of it is going to have to come through your own savings. And that's because the average Social Security check right now in America is $1,920 per month, but many people are getting much, much less than that. You had to have worked for at least 10 years or 40 quarters, right? January through March, or some quarter like that. You have to have 40 quarters like that to be able to be eligible. Now, if you just worked 40, which is 10 years, you're not going to get $1,920 per month because you haven't paid in long enough. But if you started when you were 22 and you worked until you're 65, you're going to get closer to the higher amount. But if you pay more into it, right? If you have a higher income, you're going to get more back. If you have a lower income, you're not paying as much in, so you're not going to get as much back. You can actually figure out how much you're on track to get from Social Security by going to www.ssa.gov and create an account. And you should actually do this because you don't want someone else to go do this with your Social Security number. So go claim that yourself, and it'll tell you what you're on track for. It'll tell you if you retire at 62, 65, 67, here's, given the current situation, how many years you've worked and what you've been paying into it, here's what you can expect to get in retirement. So $1,900, going back to this, $1,900 in retirement is not enough to pay for rent in most places. So how are you going to live, right? So you're going to have to augment that with some other income. And so the way to do that is to put money aside, either in a retirement account like I'm showing you here, or just a regular investment account, whatever you want to do. You start putting some money aside. What I'm going to show you here is there's 3 different individuals. There's a 25-year-old in this presentation, a 35-year-old, and a 45-year-old. None of them have started investing yet. So we're going to get them started today, and they're going to start putting in $7,000 a year into a Roth IRA, let's say, right? And again, we're assuming a 7% rate of return. So the 25-year-old is putting in money from age 25 all the way to age 65. So 7,000 times 40 years is 280,000 that they put in. So that's a lot of money over time, but it's not a lot of money every month. Every month, it's about $583. If you're doing it every 2 weeks through your paycheck, it's less than $300 every 2 weeks. At a 7% rate of return, they get to 1.5 million, just about. But if they wait for 10 years and they skipped over age 25 to 35, now they put in $7,000 a year for 30 years. Instead of putting in 280,000, they put in 210,000. So they missed 70,000 compared to the 25-year-old, but it cost them more than half of their return. Again, because of the power of compounding. Compounding means that when you put in the first 7,000 in the first year, when it grew by 7%, it became $7,500, right? And so the next year, when you're getting a return again, it's not on the 7,000, it's on the 7,500. And the next year it's on 8,200, et cetera. That's compounding. And if you really waited too long, you're 45 now, and you only ended up with 300,000 because you're putting in 7,000 per year. So what this will tell you is that the larger the amount that you have, the better chances at success. Because if you continue to receive a 7% return even in retirement, okay, so let's say you're 62 or 65. In this case, we said 65, and you want to start pulling out some of the money from your nice size retirement account, your $1.5 million retirement account. If you pull out the return of 7% per year, you can pull out $105,000 per year and not pay or not reduce your $1.5 million. Your $1.5 million gave you a 7% return, which was $105,000, and you pulled out that return. That's pretty great, right? Compared to $1,900 a month in Social Security times 12 months is only $23,000. So we went from 23,000 to 128,000 because we planned ahead. We had delayed gratification. So you can see, if you're a young person on the call, you got to get started early. If you miss even 1 year, you do a huge detriment to your overall portfolio. Now, if you're the one with 300,000 at the end and you're pulling out the 7%, that's only $21,000 a year if you want to keep that 300,000 going. The beauty of this is when you are 45, you're probably making a lot more money than when you were 25. So you don't have to just put in 7,000. You can put in 17,000 or even more, right? And so you can use retirement calculators to figure out how you can get to $1 million or 2 million. It's really about being steady, ongoing, making good decisions about your investments, diversifying, and not buying and selling, and just letting it sit there in good investments for a very long time. All right, we're going to take questions at the end. I'm going to go through these next slides pretty quickly here. So the traditional IRA is something that you can get a benefit right away, right? So you put in up to $7,000 per year, and you can get a tax deduction on your taxes if you qualify. This means that if you don't make over a certain dollar amount, those are details that we can just quickly look up, right? But you're able to put in 7,000. If you're 50 or above, you can put in an additional $1,000 to try to catch up. So that's one way. And then the Roth IRA allows you to put in 7,000, but you are not going to get the tax deduction. So on the traditional IRA, if you put in 7,000, you might get 1,500 back in your taxes. You might get $2,000 back. In the Roth IRA, if you put in 7,000, you're not going to get that money back. Okay, you're not going to get the tax deduction and get something back on your taxes that year. So why would we want a Roth IRA? Well, let's go back here. Now, let's say you were the one that got to 1.5 million. If you had a traditional 401k or a traditional IRA, every dollar that you would draw is going to be taxed. Okay, so if you do pull out 105,000, which is the return on your 1.5 million, in my assumption here, then that 105,000 is going to be taxed as regular income, as if you've never paid tax on that income, right? So you'll probably pay $20,000, $30,000 in tax. But if it was Roth contributions, then you're going to pay zero in taxes. 105,000, all in your pocket, tax-free. You did not take the tax benefit early on. You took the tax benefit later. So this is something to keep in mind. There are some rules on the Roth IRA where if you make too much income, if your income is too high, then you're not allowed to put money in there. There's a way to do it from the back door. It's called a backdoor IRA. In a 401k, the government doesn't care how much your income is. They allow you to have a Roth 401k. If you have questions about these, you can ask me at the end. I think you probably could key in on a couple of good questions there. A 401k is going to allow you to put in much more money. Through your employer, you can put in $23,500. If you're 50 or above, you can put another $7,000 in. So it's over $30,000 a year. And if you're, later in life, you haven't really started when you were in your 20s, you're going to need to really maximize your 401k. If you're a business owner, we can also help you to start up a 401k for your business. It's not that hard to do. Many small business owners think that they can't really do it on their own, but they can. Just like the big companies, you can also establish a 401k or a simple IRA or a SEP IRA for yourself. The people on this call, let's say we have a 65-year-old man and a 65-year-old woman. The 65-year-old man has a 50% chance of reaching 85 years of age. Those are pretty good chances, right? The man also has a 25% chance of reaching 92. I have some family members now, mashallah, that are, 85, 86, 80, a bunch of them in that age range. May Allah continue to give them good health and life. But we can all see that, right? In the past, if someone in your community passed away at 68, you would say, mashallah, they lived a good life. Now you would say they passed away early. What happened? Did they have some kind of disease or something? Because people are living longer. Why do I mention this? I mention it because you're going to need to have enough saved up to live a long time and be able to have an income. And Social Security is not going to get you there. You may have to end up living with someone. You may not have anyone to live with. Like the difficulty comes in there. I've seen too many cases of that as well. So you want to save on your own because people are just living a long time now. And if you're a woman, even better news, you have a 50% chance of getting to 88, and you have a 25% chance of getting to 94. The cost of healthcare also is going up dramatically. So people that are retired are facing, if you're a 65-year-old, this is back in 2020. If you look at those numbers, by the time you pass away, you will have paid $315,000 just in health cost for a couple. So that's a lot of money. You have to save for that too. When I started saving when I was 19, I had no earthly clue that I need to save for healthcare cost. I just thought it was going to be to live my life and go on vacation and maybe go for Umrah and, pay my house or whatever. But I didn't think I'd have to put away money just for my healthcare. So just start putting money aside. Don't take too much time. Try to make it happen. And if you need assistance, if you have, if you want somebody to put together a financial plan for you, or if you want someone to manage your money specifically, we have investment advisory services as well. Those are things that some people really want. Some people are just happy putting money into the mutual funds because they've done very well for a long time. Others want more handholding as well, and we have that. And then just a couple more things here. You do need to have a trust or a will or a living trust. The Prophet ﷺ said any Muslim that has something of value that they're going to leave behind should not sleep for more than 2 nights without having a will. And the problem with just having a will in America is that when you pass away, the court has to interpret it, and people can also say that they don't agree with it and they can fight it. And a trust doesn't do that. And also the will, the judge will have to charge you some amount of money. I was talking to an attorney here in Southern California. He said on $1 million property, a house, if that's in a will, the court will right now, at that time, he told me about a year ago, will charge about $23,000 in court fees just to make the decision on that home, not to mention all the other assets that the person might have. So you want to look into a trust, not just a will, and that will help you, distribute your money in a halal way as well, according to the Sharia. So, we started this company and started the Amana Funds back in 1986 to do it according to Islamic principles. And along the way, we've added different funds. So you can see that the first one on the top is a long-term capital growth, the Amana Developing World Fund, which invests in emerging markets. And that was started in 2009. We started the Amana Growth Fund, which has about 45% in technology, 20% in healthcare. And that was started in 1994. We started the Amana Income Fund as the first fund. Every company within it pays a dividend. So basically we own cash cows, right? Companies that are just going to make money year after year. That started in 1986. What is that? Almost 40 years ago. And we started the Amana Participation Fund in 2015 for people that wanted to diversify away from the stock market. So if they have 70% in the market through these other funds, maybe they have 30% in the participation fund investing in something called sukuk. Now, sukuk are similar to bonds, except that they are not debt backed. They are backed by assets. So they're either asset backed or asset based. And a bond that you might find out there, maybe you had a financial advisor and they told you you need to put 50% of your money into bonds. They are riba and they're backed by debt only. So there's really no value there if the company goes under. And we have to do all of these. We have to create the portfolios and manage them in a halal fashion. And we have to do it the best way possible because we are the largest and oldest. So if we don't do a good job with this, then the entire industry probably would not do well because people would lose faith in it. And you don't just take our word for it. We also have an Islamic consultant that's independent. They're in Malaysia. It's called Amani. No relationship to Amana. And Amani has a number of different scholars on their board, and they review all of our 4 portfolios every quarter. So it's not just us telling you that it's halal, but it's also Amani certifying that, and it's on our website. There's certifications every quarter. So what does halal investing actually mean? We can't invest in banks and insurance companies. We have to look out for riba, right? Interest. We don't invest in companies that are producing alcohol or exploitative media or gambling or pork. And a company has to have less than 33% debt. The companies that we own, they typically have much less debt. And that's why during the downturn in the market, we don't usually lose as much as the overall market does because our companies are not as highly leveraged. And any company that does have some haram revenue has to be less than 5%. What that means is if you have a company that has a lot of cash, they may be earning interest on that cash, right? It's sitting somewhere earning interest. And so if that revenue from that interest is more than 5%, we can't own it. Most companies have less than 1%. So it falls into what the Sharia guidelines are that AOFI has come up with in Bahrain. This is the auditing and accounting organization for Islamic financial institutions. So pretty much done here. I'm just going to tell you that you really do need to invest with caution. Anytime you invest in anything, right? A property, stocks, some people invest in cryptocurrency, gold, silver. You really need to understand that there's going to be risk with anything and how to mitigate those risks and how to take educated risk. And I'll just tell you a couple other things here is that if you want to find us, you can find us in a lot of different places. We're on, for Amana Funds, we're on Facebook, on YouTube and Twitter. No, we're not on Twitter, just on those 2. And then we do have something called the Halal Money Matters podcast. If you want to go listen to episode number 3, that's the one that I talk about. I was interviewed about retirement and different ways to save. And also episode number 37, if you're looking at learning about how to save and invest for institutions like IMSA or your local masjid or nonprofit organization. Here's some of my information for my team here if you want to contact us and have a conversation. So I'll leave it there. Back to you. For Iko.
Okay, alhamdulillah. Mashallah, Brother Owaiz. There's a wealth of information. I think the underline that I heard quite clearly is basically like start early, right? I think time is on your side if you have time.
That's right.
Because let the compound, I guess not compound interest. Let the compounding is actually work for you.
That's right.
Alhamdulillah, we already have at least 3 questions here, Brother Owaiz. This is a lot more technical. This is from Sister Purwati. She said she want to roll over, her 401k to IRA. Her question is it a good time to do it now?
So if you have an old 401k, you're invested in something, right? So whatever the investment is, it's moving with the market, just like our investments are. So when you're moving it at the same time as you're buying it. So it's leaving one place and it's getting invested into the other. So it's okay to do it because if the market starts to go up, you are moving up with the new fund that you have versus what you would have had. So I think it's an okay time to move your money at any time, actually, if you have a old 401k. And I think, also the other thing is you want to consolidate, because what I've seen is that even with my parents, we had them consolidate a few years ago. They had accounts in so many different places, they lost track as well. Every time they would go into a new bank, and start an account, they would also start an IRA account, right? So they have IRA accounts at different places, rollovers at different places. You work for a number of different jobs. You have these old 401ks just sitting somewhere. It becomes very difficult to manage for your heirs as well, or for yourself when you're older and you don't want to have, try to find this place and that place, run around and go to different websites and so forth. So the answer is yes, you can do it, even in a downturn or an upturn.
Yeah. Maybe it's a little follow-up on that. This is probably slightly different, Brother Owaiz.
Sure.
What I think people don't really look into it is basically like 401k, it's like like a pre-tax money, right? And when you will get taxed at the end when you retire. Roth IRA, you basically, you had you tax in the beginning, but not. So some people basically like doing, like a conversion 401k to the Roth IRA.
Yeah.
What can you tell about that? Should we do it now, or what's kind of the timing? What will be the?
So I think people saw that on the graph that I showed. Let's assume again you were the person that got to 1.495 million, right? Let's call it 1.5 million. So you got to that, and we said that if it was in Roth, then you wouldn't have to pay any tax when you withdraw it because you didn't take benefit before. So a lot of people, including myself, because I started when I was 19, they didn't have Roth back then. Okay, now you have Roth within your 401k. So what I've done now, just to give you a personal experience here, I said, I have the majority of my money in this pre-tax traditional 401k. And when I start withdrawing money down the road, I'm going to pay tax on every dollar. But the benefit I'm getting is if I'm putting in, let's say, $23,000 a year, that $23,000 is not getting taxed. So I'm saving state and federal taxes, right? I'm in California. There's a pretty high tax rate here too. So I'm saving on federal and state. So I'm saving on 20,000, I'm saving $5,000. But I decided to make a portion of my 401k go to Roth 401k. So I'm starting to build up that balance there. And so when I get to retirement, in a particular year, I can say, okay, let me pull from the Roth money. Let me pull from the traditional pre-tax money. I can make those decisions. So what you can do is in your 401k, most of them will allow you to put money into both, but you're going to lose the advantage of saving on taxes now, but you will get the benefit later. Okay. Now, you asked about conversion, though. Conversion is going to tax you all at one time. So if you have a rollover of $3,000 and it's pre-tax, you might want to do that. You're going to get taxed on $3,000 as income today. But if you have a $500,000 pre-tax and you're going to convert that, it's going to show up as $500,000 worth of income today.
Yeah. So don't do it all at once, right? Because otherwise you're going to get taxed.
Yeah, just know what you're doing. Know that you're going to get taxed.
Yeah. Okay. So here's another question. So the sister, this is her question. How do we get our employer to provide Saturna as an option for retirement savings?
Oh, yes.
I roll out my saving from a previous employer to Saturna, but would like to also be able to do so for current employer.
Okay. Let me put in, because people are asking me certain questions. I'm going to put it in the chat group there. So if you're, okay, so a lot of employers will have something called a brokerage option. So when, you look at your 401k and it says Fidelity, this fund, that fund, that fund, that fund, 20 Fidelity funds, right? Or Franklin funds and Fidelity funds, you get all those offers there. What you can do, though, it doesn't tell you on there that there's something called a brokerage option. The brokerage account allows you to buy whatever you want. Individual stocks, Amana funds, whatever you want. So you call your 401k department and say, please open up the brokerage account within my 401k. Now, if they don't have it, you can ask the HR, you can say, look, I need to do faith-based investing. You don't have those options. And I would like to participate in this 401k. I don't want to stop participating. I need you to open up the brokerage account. It doesn't cost the employer anything. If you have specific questions about that, you can feel free to email me. I get those questions more than anything else.
Okay, yes, fine. So next question, this is about, the Saturna Capital product. So the sister's asking, what are the types of accounts that Amana offers, and what is the expense ratio for each of those accounts?
Okay.
So that's the questions.
So let's look at this in this way. There's accounts and then there's funds, right? Investment funds. The accounts are IRA, HSA, education savings account, minor account, etc., and Hudge account. So with those, you're not paying anything, no fees on that. We don't have fees. What you put inside of it are the funds, okay? And the mutual funds are the ones that have expense ratios. The expense ratios can be as low as 0.5% or 0.55, all the way up to 1%, depending on what you're buying. You're going to get a discount if you're opening up anything qualified. Qualified means something that has a tax benefit, like the ones I mentioned, IRA, education, or health savings account. We give you at least a 0.25% discount on the expense ratio. So let me give you a quick example. Amana Income Fund was the first fund we started in 1986. The return on average since 1986 is over 9% per year. That is after the expense ratio. So if you look up on our website, amanafunds.com, the return on any of these, it's after the expense ratio has already been taken out. So I think I answered both, right? The type of accounts are all of the above, or regular investment account, and then the fees there as well.
Yeah. And then you can see that on the website too, right? The details.
You can see it on the website. Yes, absolutely.
Yeah.
Website has a lot to offer, so you'll have to spend a little bit of time there, but I can help you with it. You can also open up an account online. You just click and it'll tell you all of the different options there.
Next question, this is regards to UGMA, UTMA. So the sister asks, once the minor reaches 18, will this then be taxed as her or his assets?
So actually, along the way, also, it's going to be taxed as so let's assume that you now have $20,000 in this minor account and it's earning you a dividend. Okay. So you have it in a Amana Income Fund and you got this dividend. Dividend is normally taxable under your name, but in this case, it's going to be taxable under your child's name, which is a good thing because there's something called the kiddie tax rule, which means that the first $1,000 or $1,100 worth of income, they don't get taxed at all. So if they go and they do some cleaning for somebody for $100, they don't get taxed on that, right? Even if you report it, you don't get taxed any dividends or anything like that. So it will be taxed under theirs all the way across from the beginning, but usually there's not going to be enough to tax. And then once they're 18 and you sell it, it's going to be under their Social Security number. And they have a lower tax rate because they're not making as much money.
Okay. Good. So I think that's all the questions. I'm going to open for the audience who happen to be in the Zoom. I know there's a couple of youngsters or youth. I would like for them to, please ask questions. I know this is a new topic for you guys, but I know you start working. Any questions that you may have? How to open account or how much should I save? So I'm seeing Adifa, Zahra, Rehan, Zakira.
So I think the most important thing to do is I'll give you a little cheat sheet while you're trying to think of your question, okay? And then maybe wrap it up after that. The cheat sheet is this. You come up with a piece of paper, okay, or a spreadsheet. And what you're going to do is on the left-hand side, on the top, you're going to put down what are your goals all the way down, okay? And then next thing you're going to say is what's my goal, my financial dollar goal? I want $1 million in retirement. I want $20,000 here. I want $30,000 for my kids. Then you're going to say, what's the time period? Retirement in 40 years, education in 18 years, Hajj in 5 years, buy a house in 7 years. And then what you do is you simply back into the number. Okay. There's different on your phone, you can find different kinds of apps that are going to help you with this. For example, there's one called compounding interest calculator. Okay. Interest can be calculated the same way as a halal return. Okay. So if somebody gives you a 10% return, it's the same as 10% interest in terms of numbers, nine in terms of Sharia, of course, right? So this just asks you, what's the initial amount that you put in? How much are you putting in monthly? What's your rate of return? And what's the term? And it'll tell you this is how much you need to put in on a monthly basis. Okay. So if you say, I have $100 to start, let's say we want to go to Hajj in 6 years and it's going to cost 30,000 for the couple, right? I'm going to start with $100. I'm going to assume a 7% rate of return, and I'm going to say 6 years, and I'll just put in some number here to figure out how much do I need to put in. I'm going to put in $400 a month. If you have $400 a month, you'll get to 35,816. Okay. So what you can do is you can figure this out with all of your goals. And I can show you how to do that, because I want you to succeed in figuring out how much you need to put aside for each one of your goals. And then you just let it run. You don't have to think about it. You just have it keep going into your account. Some of you are putting money into your 401k without knowing what your goal is, what your end goal is. So you're going to end up with something, but you don't know what you're trying to get to. And you might end up with 200,000. And if you knew that you just need to increase it by $200 a payroll or $50 a payroll to get to your number, you could make that adjustment now before it gets too late. So use that. So use, the goal, the time, the dollar amount you want to get to, the timeline, and how much you need to put in on a monthly basis, and open up a separate account for each of your goals.
Good tips. Any questions from the youngsters? IMSA youth? All right. So I'll go to the other, spectrum. The people, so others, other folks that's attending here who may be nearing retirement. Any question to the brother Owaiz? I think, brother, you mentioned about, Saturna Capital, has a service like financial planner and corporate trust too, right? Can you elaborate that a little bit?
Sure. Yeah, with the financial planning, like I was just saying, somebody might be putting money into their 401k or some type of investment, and they have no idea where they're getting, right? Where they're heading. So we come up with a financial plan where they answer questions about, how many kids they have, are they married, do they have a home, how much money is saved up, what do they want to do with retirement, when do they want to retire, how many years away are the children from going to college, and then we come up with a plan for them, using obviously software. And so the plan will say, if you do this, you're going to get to your goals. And so the financial plan is amazing, right? It gives you basically the playbook of how to save for your future. If someone has over $125,000 of investable assets, either with us or even somewhere else, we waive the $500 fee, okay? Because it is software that we have to pay for. Most of the companies charge for that, but we decide we're not going to charge, but they have to have that balance. If somebody has $1 million or more, then we will actually manage their account for them. So instead of buying a man income fund or growth fund or whatever, we'll buy individual stocks for them and create a portfolio, and then they'll have a portfolio manager and a relationship manager to work with them for as long as they have that account. What was the second part of your question?
The corporate trust,
yeah. So we don't create the trust. What we do is I have a list of attorneys throughout the country, and so you could go to one of these attorneys in your area and ask them, how do we set up a will or a trust? What will you charge me? If you want to look some of this up now, you can go to shariawiz.com. It's SHARIA, Sharia Wiz. Let me put it in the chat group here. If you go to shariawiz.com, it'll tell you all about why a trust, why a will, and then they charge a fraction of the price. But you're doing it through electronic means, right? But at the end, there is an attorney that's looking it over and making sure everything is good, and you can ask questions if there are that come up. But you can either have an attorney in your area, or you can go to Sharia. Even if you're going to go to an attorney in your area, you can still go to Sharia to figure out, like, what is this all about? How does Saturna get involved? We also have a trust company. So if somebody does have a trust, they can make us the corporate trustee instead of a relative having to manage it at death. We can do that for them.
Okay. Yeah. So Saturna Capital here being the trustee, right?
Yes.
For that, whatever that living trust is. Okay.
That's correct. Yes.
Okay. There's a few other questions here. The first one is, I guess in regard to the, is there like a minimum amount if somebody wants to buy like either Amana Growth or Amana Income? Is there a minimum amount, of dollar value, if you will?
Right. So when we first started, we started as for the community, because it was actually Muslim community members that got Amana Fund started in 1986, right? The idea was in 1984. So now today, the minimum is like $100. It used to be 5,000 in certain, when we have a new fund come up, we need it to be a little bit larger, like participation fund. But then once we have enough money in there, we lower that one too. So all of them, all you need is $100 to get started.
That's it. Okay, $100. Okay, good. The next question is, maybe this is about, like historical periods. How all those Amana funds, weather the storm, like in the past, like maybe back in 2008 when there's, credit crisis, maybe 2020 when there is a, basic COVID. How's the either income or growth, weather that storm?
So both of those were around in both of those periods of time. The Amana Income Fund was down 23% in 2008, and the market, I believe, was down 40%. Okay, I'm going to look that up. Amana Growth Fund was down 29%. Obviously, that's a huge amount. We don't want to lose that much money. But if you lose as much as the market lost, you're going to have to make up a lot in the future, right? But the next year, they both made up almost all of it. It was a great year in 2009. So how much was the market down in 2008, right? We're gonna say the S&P. Let's see what my memory, because my memory was like 39 to 40%. It was down 37%. So income fund was down 23%. It saved our investors by 14%. If you're down 10% in one year and the next year you make 10%, you're not even yet. You have to make more.
Right. Yeah.
So if you're down 37% versus 23, you have to make up a lot more. But in the ensuing years, the next 10 years or so were unbelievable, right? Like up until last year was great. This year, Amana Income Fund is flat. It's like negative 0.18. During COVID, we did not lose as much as the market did, and then we turned it around, and we had a huge year in that COVID year as well, just like the market did. Again, this is partly because of long-term holding, low portfolio turnover, and having lower leveraged companies versus higher debt companies.
Right. Yeah, seems like either faith-based, investment or ethic-based, investment seems like, can ride the storm, quite well compared to the rest of the market. Yeah, alhamdulillah.
Yes.
Okay. I think there's no further question from the audience. So alhamdulillah, jazakallah khair, Brother Owaiz, for the knowledge sharing, hopefully, whatever the knowledge that, Brother Owaiz shared tonight, inshallah, can be, be part of his jariyah. So inshallah, I think for us who listen to this, to this Zoom or any broadcast after this, I think one thing, if you haven't started, please start. Especially for you guys or just start working, and start earning money, please start, saving, as soon as possible. It doesn't matter whether $5, $25, you saw from that presentation that the compounding the time is, basically like help you out, right? For us, who has been, been professional or maybe nearing retirement, again, it's not at the end of the day. I would say, there's still, light at the end of the tunnel. So start basically like, invest your money or invest your assets in a responsible manner. I think Brother Wise, you can be contacted, right? I mean, yeah, I know Brother Wise since like basically mid 90s because I start, investing in Saturna back then when Amana growth is like $14. So I remember that.
You got it in earlier than I did. I started in 2008.
Yeah. So inshallah. Okay. Just a call here for participants. Just a call here for Brother Owaiz for his time tonight. Inshallah, we're gonna close our session tonight with doa kafaratul majelis. Bismillahirrahmanirrahim. Subhanaka Allahumma wa bihamdika asyhadu alla ilaha illa anta astaghfiruka wa atubu ilaik. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.